If you haven't already made your New Year resolutions, now's the time to do them. In this week's Invest segment, we've got tips and advice on how you can spend and save wisely. If you're planning to buy a new property this year or already have an existing mortgage, be sure to pay closer attention to the loan packages and what they entail. Knowing the details of the loan and what you're agreeing to could save you a few $1,000s each year. Let's find out more about managing a home loan with our Invest editor, Tan Ooi Boon. Ooi Boon, to be honest, it can be rather mind-boggling when it comes to picking the right home loan package. So let's make it easier for our viewers. What are the 3 things that people need to be aware of before signing up?
First of all, you should know that there's no such thing as a stupid question when it comes to your money. So don't be shy when you meet your banker, because you need to ask as many questions so that you can pick the best loan package for yourself. Essentially, there are 2 broad categories, fixed and floating packages. But you need to do your homework, because within each of these categories, there are many choices. Right now, to make it easier, if you don't mind taking a bit of risk, go for the floating rate, especially those that involve the new SORA rates, the Singapore Overnight Rate Average Interest Rate Benchmark, as it offers some of the lowest mortgage levels now. But you need to ask your bank before you sign up how future rate increases can affect the quantum of your monthly repayment. So ask your bank to tell you the various scenarios that will trigger a rate revision of your home loan. And if there's a hike, find out how much time you have before you need to pay for more installments. Finally, don't forget to ask about the refinancing process too, because you will need to do this every 2 to 3 years later. Loan repricing is something that all borrowers should look at regularly, especially when the new rates are more favorable. It is cheaper and easier to do it with the same bank. So it makes sense to ask about all these things when you meet them. And finally, before you leave, ask also about the loan redemption, as in how you can pay lump sums to pay your loan, to reduce your loan without penalties. You need to know this in case the rates jumps higher than what you expect in the years to come. And never get tempted by the free gift. If you can score a good loan, you can buy those gifts yourself with the saving, and that is just in the first year.
Great advice there. So, Ooi Boon, the start of the new year is also a good time to review one's finances. For me, it's to understand, where my money goes and to keep track of my spending. So, Ooi Boon, what are some of the financial health checks, shall we say, that all of us can make to ensure we'll always have enough money?
Well, let me just share 2 golden rules to help you. First of all, you need to have more income than debt. To check whether you have enough money every month, what you need to do is add up all your fixed loan installments, especially when you are thinking of buying a new home, and then divide this number by your monthly income or salary. This means total loan divided by total income. This is what is known as the total debt servicing ratio, TDSR, which is important if you're getting a new loan. If your total loan is more than 55% of the income now, the bank is unlikely to give you the loan. So if you fall into this category, you need to fork out more cash to pay for the property or look for a cheaper home. The second test that will ensure that you will always have enough money to spend is more important. You first need to know how much your family actually spends every month. You can do this only if you add up all your phone bills, your bills not just for your phone, for essential expenses such as grocery, utilities, transport, and other household items. You also need to add up all your loans, your insurance premiums, since you have to pay for these too. Once you have this number, divide your total cash savings with it, and this will tell you how many months you can last if you suddenly lose your income. What it means is this: total cash divided by monthly expenses. If the result is single digit, well, you need to start to save more, because downturns such as the current COVID time can last for a few years. This exercise will also give you a good idea how prepared you are for retirement, because you will truly need to rely on your savings for your expenses when you stop working.
Thanks so much, Ooi Boon. Invest editor Tan Ooi Boon. To find out what the other 2 financial health checks are, you can read Ooi Boon's article at str.sg/invest. You'll also find regular features on career and retirement planning, as well as tips on how to build wealth.